Hello everyone, and welcome to our channel, the channel where we make data easy to understand. Today, I bring you an animated chart showing the behavior of equities versus commodities from 1970 to 2025. This chart was created specifically for this video, using the data from the chart you see on the screen. As we progress, we will break down the key historical events that influence these trends. By the end of this video, you will have a unique perspective on why commodities could be an interesting investment today. Let's start in the 1970s. This was a turbulent decade that marked the beginning of many of the trends we still see in markets today. In 1973, the world experienced the first major oil crisis. OPEC countries imposed an oil embargo, leading to a dramatic increase in crude prices. As oil prices rose, so did inflation, negatively affecting stocks in general. However, commodities like oil and gold became safe havens for investors. On the other hand, equities suffered a significant drop, with the S&P 500 losing almost 50% of its value between 1973 and 1974. Notice the first lesson here? Commodities are sensitive to geopolitical tensions and can be a refuge during times of uncertainty. The oil crisis also highlighted how changes in the supply and demand of a single commodity can have global repercussions. This event pushed many countries to reconsider their reliance on foreign oil, initiating movements toward alternative energy sources. Although the results were not immediate, it marked a turning point in the global economy. Let's move forward to the 1990s. Although this decade is remembered as a golden era for tech stocks, there was also a major crisis that impacted commodities: the Gulf War in 1990. This event caused a sudden spike in oil prices, affecting the global economy. During this time, the stock market continued to grow, driven by technological innovation and market confidence. However, commodities like oil and gold remained volatile, reminding us that they are essential tools for diversifying risks. Moreover, the rise in energy prices affected industrial companies, which relied on low costs to maintain competitiveness. On the other hand, commodities like gold didn't experience the same upward trend during this decade due to increased confidence in the US dollar. This is a perfect example of how macroeconomic and geopolitical factors interact to influence commodity and stock prices. Now we arrive at 2008, the Great Recession. This was an event that hit both equities and commodities, but in different ways. While the S&P 500 dropped 57% from its peak to its low, oil prices also plummeted from $140 per barrel to less than $40. Commodities were not immune, but here's something interesting. Gold, a key commodity, acted as a safe haven, rising during this crisis. This event once again demonstrated that commodities play a crucial role in well-diversified portfolios, especially during periods of high stock market volatility. Additionally, the 2008 crisis highlighted the global dependence on energy commodities. Emerging economies, especially China, continued to consume enormous amounts of oil and industrial metals, helping stabilize these markets after the initial collapse. This episode shows how demand for commodities in emerging markets can act as a counterbalance during times of global uncertainty. On the other hand, this crisis also marked a significant increase in financial regulation and a shift toward more sustainable practices. Investments in renewable energy began gaining traction as a response to oil volatility, marking the beginning of a structural change in the energy sector. This period served as a reminder that adaptation and diversification are key to surviving economic crises. Finally, the Great Recession underscored the role of systemic risk in financial markets. Investors began seeking tangible assets like gold and other commodities as protection against financial uncertainty. This reinforced the importance of commodities not only as hedging tools but also as essential assets to balance a portfolio in times of extreme volatility. Let's move to the 2010s, a period dominated by the rise of tech companies and the Magnificent Seven. Companies like Apple, Amazon, and Microsoft drove the S&P 500 to historic levels. However, during this decade, commodities faced a different reality. Oil prices dropped drastically in 2014 due to oversupply, affecting economies dependent on crude. Meanwhile, cocoa, a less discussed commodity, saw significant price increases, directly impacting companies like Hershey's, HSY, which had to deal with higher costs and reduced margins. This decade also marked an important shift in the perception of commodities. With the rise of renewable energy, oil began losing its prominence as an indispensable resource. However, metals like lithium and cobalt, essential for electric vehicle batteries, took center stage, highlighting how technological transitions affect commodity demand. Furthermore, the increasing interest in ESG, environmental, social, and governance, investing began to shape commodity markets. Investors and corporations started to prioritize sustainable sourcing of raw materials, creating new challenges and opportunities for the mining and energy sectors. This shift emphasized the growing role of responsible investing in commodity production and trade. Additionally, geopolitical tensions, such as trade disputes between the U.S. and China, influenced commodity markets significantly. Tariffs and supply chain disruptions caused fluctuations in the prices of key raw materials, further demonstrating how interconnected the global economy had become by the 2010s. These events underscored the importance of understanding macroeconomic and political factors when analyzing commodity markets. We've arrived at 2025, where the S&P 500 is at historic highs, and commodities seem undervalued. With high prices in the stock market, many investors overlook the potential of commodities, but should they? The recent drop in oil prices could be an opportunity to enter an undervalued market. Historically, we've seen that commodities tend to rebound after periods of decline, especially when geopolitical tensions or economic changes bring them back into focus. In this context, we must also consider the impact of commodities on specific sectors. For example, high cocoa prices have notably affected companies like HSY, which depend on this raw material. On a macro level, commodities like oil and natural gas remain essential for global economic stability, while industrial and precious metals play key roles in manufacturing and technology. Moreover, the future of commodities could be shaped by new technologies like space mining and advanced recycling, which could significantly alter supply and demand. Although these developments are still in their early stages, they are important factors to consider in long-term investment planning. In conclusion, history shows us that both equities and commodities have their place in a well-balanced investment strategy. Today, with U.S. stocks at record highs, we cannot dismiss commodities as a viable option. Oil, gold, cocoa, and other commodities not only affect the global economy but also specific companies like HSY, which struggle with high costs. And before you go, don't miss our next video, where we explore why investing in the Magnificent Seven today might not be the best idea. See you soon.